give you a quick sense of where there is more green and red. And there you go. So it's largely up and about. And metals, I mean, the two metal names, JSW and Tata Steel, that Morgan upgrade that I was talking about earlier, they're there. And on the other side, you've got a couple of financials, HDFC Life and Kotak, etc. There's ICICI Bank as well. So, but bulk of it, 45 odd names are opening in the green as far as the Nifty 50 go. Surbhi.
It's really metals all the way. I mean, all through the last week, the metals pack has been fired up, and it's all China related. Hopes that production cuts will kick in and therefore stabilize prices perhaps here in India as well. Tata Steel, JSW Steel, 3% on these stocks. Big moves coming through. Even Hindalco is up, but the rally in the party is more in the ferrous space than the non-ferrous space as the day kicks off. Mahindra and Mahindra announcing those price cuts, 1.5% lower. Tata Motors, 1.5% higher. Ditto for Tata Motors, also up 1.5%. Let's see what IT is doing. Not too bad, actually. Remember, IT had a very wobbly Friday because of some absolute fake piece of, information that was floating around. There were concerns, lingering concerns, but it seems that the statement from Mr. Donald Trump, that for now is stabilizing IT stocks. The index is up, TCS, Wipro, most of these stocks are also on the upside, so no problems over there. Some of the life insurance stocks are still correcting. SBI Life, HDFC Life, down between 1% to about 0.7%, depending on which one you're looking at. And banks are very quiet. ICICI Bank, Kotak, all of them. Axis Bank, absolutely at the flat line. Let's look at HDFC Bank, absolutely flat. Let's see if the Bank Nifty decides to lift off. But right now, a very quiet start for this one. Nigel.
Well, that's right. Let's keep a few stocks on the radar. The newly listed company, Vikram Solar, they won a 336 megawatt high efficiency solar modules. I think that's the reason why post that order win, the stock is up close to 4%, and volumes are very, very high. So that's one stock that I'm noting. The other one is Prime Focus, large trade on Friday, large trade today as well. Well, the street seems to be sniffing some kind of news out there because the volumes are extremely high, more than 3.5%. Actually, now more than 5% of equity has changed hands in the first couple of minutes itself. Suntech Realty, promoter showing the faith. The street likes it. The stock is up and about. Swiggy is higher. Nomura came out with the note. They have initiated coverage. Target price of around 550 rupees. The stock is up close to around 3%. They are pointing out that the food delivery business and steady profitability path and a key cash generator. So that's a couple of points that they put out there. Vedanta, timing is wrong. The metal index is up. Vedanta wants to foray, and take a new challenge on. Could be positive in the longer term, but for the near term, the street is saying you've got enough on your plate. Just focus on that. And that's why that's actually underperforming in today's trading session. So that's under some pressure as we speak. JTL is another stock from the broader markets that's moving higher on very, very large volumes. And I think there was an announcement over the weekend about Ola, a couple of funds entering as well. The stock was under the weather in Friday's trading session because it was put in T2T. But today it's popping back up. It's up close to around 2%, though it was one of the big losers in Friday's trading session. So a good opening. We're holding at around 24,800. The broader markets, that's the one where you're making money.
Absolutely. By the way, so it's a 60-point bump on the Nifty. We're at about 24,800 as things stand right now. So it's a decent start. The number one volume-led gainer right now is NetWeb. NetWeb is trading with another 6% pop. And I must say it's completely re-rated, in the last 5 days or so, basically, right? I mean, not completely but maybe a little. But it's gone from what, $2,300 to $3,200. It's gone up $1,000 in about 4 sessions, 5 sessions flat, and almost nearing 1 million shares on NetWeb coming through. The other one, of course, was E2E, where L&T picked up a stake. I can't spot it today, but otherwise it's done very well. TBO Tech is back to, it had that big move post the acquisition, then it sold off a little bit, but it's basically back at those high levels, 1,600 rupees or so, 1,615 on TBO Tech once again. What else? Shalby Hospitals had a very large move on Friday, and it went from, basically 196 to about 220 on Friday, and it's up another $20, 238 now, 240 basically. So in 2 sessions, Shalby's done phenomenally well. Prime Focus, of course, we've been highlighting. There's another large crore-odd shares which is traded. So 10 on Friday, 10 today. So 20% in 2 sessions flat. And then you got a name like Mosship. I highlighted this on Friday as well. And Mosship is up another 7%. So again, it's what, 5 sessions, stocks gone up from 160 to 260, 266 actually today. So there is a Moschip, and by the way, it's the third largest volume-led gainer on the NSE. And that's the reason why we are highlighting it. More than 500,000 shares which are traded on this one.
Just a couple of more stocks, Prashant. The reason that TBO Tech is reacting today is because the deal was announced, mid of the week, but the con call was on Friday post-market hours. So that's why brokerages have come out with their notes as well. In our morning chat, on the day it was announced itself, the early morning, we had said that could be the stock. I think from there it's up closer on 20%. The other one we pointed out with regard to delivery-based buying is First Cry, Brainbees. The stock, it was at around 350 rupees odd. It's now at around 420 rupees. A big underperformer, but that seems to be coming back into play. And that's why that one as well are following up Friday's trading session with another 4% gain. So interesting to see whether or not it can hold on to that.
All right. Kenneth Andrade is now with us. He's CIO of Old Bridge Mutual Fund. Kenneth, great to have you with us here. Thank you very much for joining us. Really appreciate your time, and you're back after a while. Kenneth, we've got 3 powerful kind of things which the government's sort of done, government and the RBI, tax cuts, rate cuts, and now the GST cut as well. And perhaps there is more coming. From when we speak with bankers, we get a sense that the RBI is very keen to kickstart growth, and they are looking for ideas in terms of what they can do. From the government side as well, we hear this is the first of many coordinated steps. How has this moved the needle for you in terms of your thinking about what can happen for the consumption part of the market, Kenneth?
Yes, there are a number of events that have happened over the last couple of days, including the big GST cut that's been there. So the focus has moved to the domestic environment. Obviously, what's happening internationally in terms of realignment of the trade cycle, we necessarily have to refocus our entire energies into see how we can kickstart the domestic economy. And whether it's the central bank or whether it's the government, we're pulling out as many steps as we can to restart the domestic environment, and it's coming at probably an appropriate time in and around the festive season. So it's going to be good for volumes this quarter, for volumes going into this couple of months, and that should hold up the economy for a while. So yes, from an investment perspective, the focus is now the investing and the investors' focus is now on the domestic economy. We're heading into one of the biggest festive seasons that are there, and we've got all the right steps to see how volumes hold up during this cycle.
Kenneth, hi, good morning. Great to have you on. So, even if it is maybe only a tactical play, actually tell us if it's going to be more a structural or a tactical play for you. But how would you play this mega consumption boost, festive season boost? Would it be through the durable companies or the AC guys? Would it be through, plain vanilla FMCG? Where do you see some sort of durable improvement in earnings and, some degree of perhaps valuation comfort as well?
I think biggest beneficiaries out here are discretionary spending. Okay, and that's where also the largest cuts have taken place. So you just keep an eye on how the cycle works out, especially for the automotive guys and the large appliances guys. Apart from that, may not be too much for too many of the other businesses, and the other businesses are all relatively small ticket items. But like I say, we should see a large volume throughput. And if you see a larger volume throughput, the biggest fixed costs that companies are sitting on are the segments of the market which have relatively high fixed costs are the durables and the automotive guys. So those kind of companies should see a relatively higher increase in margins, or should I say profitability going into this season. Now, the second question that you asked me, whether it's a tactical play or whether it's a structural basis. Look, we need to do incremental things because the market and the economy is going to be dictated by the environment, which is both outside as well as inside. We've been through a reasonable amount of high single-digit growth over the last 2 years. With whatever is happening on the ground, they should continue. But I think the economy globally has to stabilize. when we can find ourselves into that economy and then start a relatively higher GDP growth from there.
Okay, got that point. Kenneth, shifting the direction completely from local to global now, metals, in particular ferrous, there's a lot of excitement. Now, perhaps it's to do with the fact that China is actually looking at cutting capacity, maybe something else. But what do you make of it? What's your stance on metal stocks? And if you like anything, what part? I mean, ferrous, non-ferrous, or are you avoiding altogether?
So we've fairly indexed to the metal cycle as a fund house. So the fundamentals are all in place. Cash flows, capacity expansion, profitability, the domestic economy, even the international economy. Indian metal companies were doing pretty much okay. Okay, whether it is ferrous and non-ferrous, and the profitability or the near term will always be dictated uh, by events that happen. And whatever is happening with the metal cycle today, it all adds back to incremental amount of cash flow. So if you look at all of these businesses, they're very stable in terms of balance sheet. They're very stable in terms of cash flows. They're very stable in terms of putting capacity to work. Anything incremental will add additional profitability, and incremental profitability actually bodes very well for some of these companies because most of them are getting now funding most of their expansion through internal accruals. So cutting capacity in China is one of the biggest events for the metal business or for the ferrous business to find some kind of price stability, and I think that's what really the market is reacting to in the near term. In the medium term to a longer term, I think we are very constructive on this category of companies, whether it's ferrous or non-ferrous. All of these companies are working with reasonably low cost of manufacturing. And it's a very protected market as far as the Indian environment is concerned. So margins are fairly stable also. So that's where we are. I don't think there's any large price risk on the downside to these kind of names. On the upside, obviously, it depends upon what happens internationally to determine the overall appreciation of these companies.
Kenneth, so you have exposure to metals, right? I mean, as a space.
Yes, we are fairly indexed to that.
Yeah. So run us through what you own, and divide it, if you can, into two parts: what you've owned for a long time and what you bought recently.
Starting with metals, I think that's been in the portfolio from day one. We've got both exposure to the ferrous side and the non-ferrous side. That would be close to about 8% of the entire portfolio. We've been holding on to the category of pharmaceuticals that are there, mostly companies indexed to generics. I think a lot of capital is getting deployed out there in terms of finding a business model. Now there will be question marks around is this the right time to hold these companies? But this is the right time for entrepreneurs to find their business model out there. And if I just step back a little, it's not everyone's right to win in whatever is happening across the world. You got to pick entrepreneurs who are reshaping their business model to address a structural change in the way business is actually getting changed. So we're not very apprehensive of that cycle. We're going down company by company and allocating capital into some of these businesses. Okay, from a discretionary spend side, I think real estate has been a reasonably large holding. Aviation is there for since the start of the fund. We've got an automotive business or Maruti, so as to say, which is about 5.5% of our entire holding. That's been there for the last 5 or 6 months, which has been a recent entrance, of course. And we hold a couple of small names in the QSR and the discretionary spendings on the alcohol side. So that's our discretionary basket put together. That would be close to about 32% of the entire portfolio right now.
So how many stocks in total, Kenneth?
We run with about 22 stocks. The category that we address is the focused equity fund, focus category, and Old Bridge Focus Equity Fund is the product out there.
Oh. Okay, so fairly sort of diversified in that sense. Nothing, of course, nothing in IT. I don't remember you holding IT services in any good measure.
Well, there's just one business that we hold, which is an HCL Tech, and that's a reasonably large part of the. So when you hold 22 names, each of these names will be between 5% and 8% of the portfolio, right? So it appears to be large, but it's a fairly well diversified in terms of weightages.
Kenneth, before we let you go, maybe a view on defense. We'll get actually Ria up in just a second to talk about this 15-year new roadmap, which the government has announced in terms of procurement and where the focus areas are. Everybody understands and perhaps agrees that it is a long-term sector here in India. It's here to stay. But the question is what part of it to pick? Where is there some valuation sort of headroom? Your thoughts?
Well, in terms of valuation headroom, I think a large part of it is already captured, and not just in the domestic environment, but also in the international environment. So that's where defense stands. It's a long-term play. Yeah, the capex cycle is actually started. You've already got the numbers out there. You can value these companies based on whatever numbers that's coming out from individual governments out there. Any export opportunity that is there for some of these companies would be the upside if it's reasonably large. But I still tend to believe that this will largely be driven by government capex on the ground. Valuations are tight. I don't think there is significant space for valuations to move northwards. It's just left to how these companies can deliver in terms of earnings and in terms of how their balance sheets fall in place.
Okay. All right. Good to have that advice. Thank you very much for joining us this morning. Appreciate you taking out the time. And we look forward to connecting again soon. You have a good day. Thanks. Well, that's a view coming in from Old Bridge Mutual Fund. Now, since we were just discussing defense, let's understand what is this 15-year roadmap which the Defense Ministry has outlined and what is going to be the focus area. Ria is here with the fine print. Ria.
Well, yes, good morning. Let's understand what this defense roadmap is about. The Indian Defense Ministry has laid out a 15-year roadmap for the industry, which is essentially a blueprint guiding the armed forces technology and equipment needs till the 2030s. And it focuses on modernization, innovation, as well as self-reliance. And although it is not a purchase commitment, it does signal future priorities. First, coming to the priorities for the Indian Army, they will be focusing on next-gen tanks, which includes active protection systems for T-90 tanks as well as FRCVs, which will replace the T-72 tanks and light tanks as well. For missiles, they are looking to procure 4th and 5th gen ATGMs, air-to-air missile systems for helicopters, as well as ULP GMs. And for communications, they will be looking to procure advanced integrated electronic warfare systems. For the Indian Navy, they are going to focus on nuclear-powered warships, which will include nuclear propulsion for future aircraft carriers as well as other surface combatants, and they will also focus on modernizing their fleets, which includes next-gen destroyers and frigates, next-gen corvettes, as well as next-gen fast interceptor crafts, as well as MCMVs. They are also going to focus on surveillance and sensors, which includes airborne AESA radars for fighter aircrafts, oceanic satellites, and electro-optical sensors. And lastly, they are going to focus on autonomous systems, which includes high-endurance autonomous underwater vessels and unmanned mine countermeasure suites as well. Coming to the priorities for the Indian Air Force, they are going to focus on long-range precision weapons, which includes cruise missiles, guided ammunition, air-to-surface missiles for fighters and bombers as well. They are also looking to procure space or air-to-ground high-speed communication systems, as well as drone or UAV-based signals intelligence and electronics intelligence. There are also some requirements, some joint requirements for the tri-services, which includes remotely piloted aircraft systems, air-to-surface and surface surface missiles, as well as hypersonic missiles, for which they are looking to procure over 500 scramjet-powered systems. And the last thing they will be focusing on is AI-driven warfare, which includes advanced electronic warfare, counter-UAS systems, as well as next-gen targeting. Now, who stands to benefit from all of this? Essentially, all defense players, once the final procurement approvals or these orders flow through, which includes your PSUs like HAL, Bharat Electronics, BDL, all three shipyards, as well as the private defense players.
Okay, so the entire ecosystem benefits eventually, starting first with, of course, the heavy lifters, the big PSUs. Got that point, Riya? Thank you very much for giving us the details over there. Let's look at the market. Quick glance before we move on. Market's actually cruising along quite nicely, 85 points higher on the Nifty. 24,800 is here. So let's see. Well, we've been in conversation with a number of companies to understand what the GST cuts are going to mean for the companies and for the individual sectors. And we're putting the spotlight now on the auto ancillary space. Sunil Bohra, Group CFO at Uno Minda, is with us now. And of course, our three talking points are the overall impact of GST cut on auto parts, specifically on the company. What is the impact on volumes and margins? And then what do these cuts mean for EV adoption? Because the tax differential between ICE and EVs reduces with the kind of cuts that have been announced. So let's go step by step. Thanks very much, Sunil, for joining in. So let me start right there. First of all, how much of your, in terms of by revenue, how much of what you were producing was in the 28% bracket, which now comes down to 18%? So how should we start understanding the impact on your company, and what happens to the existing inventory in the pipeline?
Yeah. So starting with your first question in terms of the products GST 28 versus 18. So large part of products were actually in 28%, which will get into 18%. But because we are primarily into a B2B business, which is almost 90% of our revenues come from the direct OEMs. So there you won't see any impact because GST, we all know, is a pass-through. So from that perspective, there is not going to be any impact. But yes, from a B2C perspective, which is the aftermarket segment, which is almost 9-10% of our revenues, definitely their prices will come down in line with the tax cuts. And this, we do hope that that will bring in some sort of consumption. But it's a little early to comment because the consumption which we see in aftermarket is primarily a need-based consumption where you want to replace products which you need to. And you don't just replace like that just because taxes have come down. So you may not see any significant impact, but yes, it will bring the prices down in the B2C segment. Large part, 90% revenue B2B, as I said, no impact.
And how is the implementation going to be carried out? My second part of the question was just to understand the technicalities of it. How do you mark your current inventory? Because 22nd onwards, the tax level will be lowered, right?
Yeah, absolutely. So from inventory perspective, obviously they are currently carried at cost only. We don't carry including GST. So whatever GST you pay, that is anyway taken up as an input credit. So that lies a credit in your GST account, and the new revenue which happens post 22nd of September will happen at 18%. So from a pure B2B perspective, definitely it's not a significant impact other than just changing your rates.
It's pretty smooth, yeah. Okay, got it. So the transition for you remains very, very smooth. Yeah. 9 to 10% of your business is B2C, and that's where we need to see if there can be a further leg up. Got that.
All right. Hi, Mr. Bohra. Good to see you in, sir. So clearly, this will spell better times for the way ahead. But a quick question, does the GST reduction impact your pricing competitiveness in comparison to imports? Is there a threat of imports?
Not really, because when you import, there is a separate custom duty or the taxes plus the GST. So from that perspective, we don't expect any significant impact because when we sell, obviously we sell at cost plus GST, and when you import also, you have to pay similar taxes, which you can avail the input credits.
All right. Now the hope is that demand comes back. But what were your observations for majority of the second quarter? Was demand okay? Was it faltering a little bit? Many on the street believe that, tariff or not, there were some measures that were needed to be taken internally, and that's been taken. So what is your analysis of demand?
From our perspective, our demand is primarily to our end consumers, and that has been on the trot as per the annual guidance and the month-on-month guidance which we get from our customers. So from our perspective, whatever components get into vehicle manufacturing, there has been negligible, I would say, no impact or no meaningful impact from this rate transition, because we all know because of this anticipated rate cuts when it was announced to when it is impacted, there has been some deferment. Maybe people would have chosen to defer their purchases for the time being because of this anticipated benefit. But despite that, our customers have been continuing the production because it was primarily deferment for a few weeks, and it is not seen as any significant downside. In fact, we are expecting that post this rate cuts in line with the industry, we do expect that the demand should go up. Now, how much it will go up, I think everybody's in like wait and watch mode, because this definitely brings the prices down, as we all know, significantly, and affordability definitely increases. So government has done multiple actions, we all know, right? Leaving more hands of money in the tax payers' hand by reducing the tax rates or the 12 lakh rupees of tax exemption. Then now we had these rate cuts by RBI in terms of interest rates. Now we have these GST cuts. So affordability definitely has improved on various counts. So overall industry is very, very optimistic.
Sunil, hi. Morning. You know, there is a tax cut here. There is indirect tax hike in the US. A lot of these one-offs. But at a fundamental level, can you give us a sense of how business is progressing? What's happening? How's demand otherwise on a steady state basis across your product categories? What is the direction of travel?
Prashant, we continue to have our same trajectory. There is no hiccup. In fact, there are positive signs. Industry is preparing for the next leg of significant growth. We all know all our customers are expanding, and so we are. We have almost 12 new plants which are under construction, and we are quite optimistic that the growth momentum or the phase currently we are in, that is here to stay for a quite long time. So from volume perspective, yes, they have been broadly in line with what we have been estimating. And from 22nd of September, we are all gearing up for meeting our customers' demand should there be an increase in end customer demand.
Many of these OEMs have already passed on, right? Effective immediately. They're not waiting for the 22nd.
Right. You're right.
So in that sense, I mean, you should be hearing from these from the OEMs. I mean, now, in the sense, right? Of course, depending on what they are seeing on the ground after these price cuts.
Yeah. So that's what perhaps a little early to comment what they're seeing on ground, because to pass on the message till the end, it will take some time. But as I said, there has been no impact on volumes because of this anticipated cut post 15th of August. And our customers have been sort of building up inventory. And from that perspective, our operations have been going in a very steady, smooth way.
So all things put together, Sunil, this year, what, 20% growth? More than that? Less than that? Teens?
Very difficult to say, but I can tell you that in the first quarter, we all know industry grew by a couple of percentage points, and we grew by almost 16%.
Yeah.
So obviously, we do expect industry to grow, and hopefully, we should be able to maintain our growth rate what we have delivered in the first quarter.
The third point we wanted to understand, Sunil, was whether will suddenly get that much more affordable, right? So the propensity of just going in for a nice becomes very direct. What's your thought on this?
Very difficult to say, honestly, because there is a section of a consumer which is preferring EV because of not only the cost differential, but also because of the cost of running, cost of operations, and maybe impact to environment, etc. A lot of regulations there now which are driving in terms of what vehicle you can drive on road, because we all know the pollutions have been spiking. There are various factors why people have been adopting for EV. Yes, this price reduction might impact a little bit, but we are in a very nascent way or nascent stage of the EV volumes. Two-wheeler is somewhere around 7 to 8%, three-wheeler is something around, four-wheeler is around 3 to 4% of overall volumes. We are very small and base, so it has to grow. Now, how much it will grow, its time is only tell, and that's why we say we never normally sort of try and speculate what the penetration is going to be. But overall, long term, we still believe that the numbers where we are today will increase despite this, what you call the price differential being reducing.
Sunil, we leave it there. Good luck and, all the best as you continue to execute when what seems like a pretty good trajectory of growth for you. As you said, 12 new plants under construction. Growth over a long period of time. There'll be, of course, pulls and pushes and a little bit here, a little bit there, but seems to be on pretty good track. Thank you. That is Sunil Bora of Uno Minda with perspective on the business. 24,800 on this Nifty. We're up about, 90-odd points right now. I highlighted NetWeb in the morning as we opened up. NetWeb was up 7%. It's cooled off to about being up 2%, but it's still the number one volume-led gainer right now. Moss-Ship is still up 8%. There's another company called, MICEL. It's not a new company. It's been around for a while. It's basically MIC Electronics, basically. It's shortened to MICEL. It's up on very large volumes, some 1,700 crores in market cap, $77 on your screen, and 17%. Very large volume. Number 5 across the NSE. So you got many of these shooting stars coming up, right? Look at JP Power, 5% higher on JP Power. Again, very large volumes at this point in time. And of course, some of the other stuff is we've already highlighted. Volumes are still picking up through the course of the day. By the way, on the Nifty, we're up 90, but we already had one dip. The market was up 60 points. It sold off to being absolutely flat. And then this is now the second move higher, which we are seeing at this point in time. We'll take a quick commercial break here. We're going to come back and banks and financials and focus on the other side. We'll have Vishal Goyal of UBS joining in to talk about exactly that. Stay tuned. Coming up.
Welcome back. Well, we are continuing to decode the implications of this big boost, economic boost that's been given in the form of the GST cut. We're putting the spotlight on the financial sector now. Vishal Goyal, Managing Director, India Financials Analyst at UBS, UBS Global Research is with us now. And of course, we want to cover 3 talking points. Credit growth and how might that shape up from here on? Of course, what are the expectations from the RBI? And of course, bank earnings. Really, will things get better as we progress down the line into this year? Vishal, great to have you on. So let's take it step by step, starting with point number 1. Now, a lot of people believe that maybe a good way of playing the GST cut, the stimulus that's being given to the economy, would be through financials, because eventually, perhaps, people borrow more. Do you have that view? And where are you in terms of your expectation of system-wide credit growth? And which are the subcategories of financials which will perhaps surprise on the upside, purely in terms of growth?
Hi, Surabhi. Thanks for having us. So, yes, I guess the H2 expectations are generally high. Like we are all expecting the rebound in H2. And thanks to the stimulus from government in various forms, whether it starts from the IT rebate, GST now, plus the monetary easing, which we have seen. So we are from deficit liquidity to now surplus liquidity. So I think all this should enable some pickup in the credit growth. Now, from current 10%, we are estimating it to go to 11 to 12%. And a lot, of course, will depend on how the festive season goes and how the consumption cycle picks up. In terms of, I think, the breakdown, we still feel the consumption will continue to drive the growth for the system. I think the corporate capex is still small to drive overall growth. And therefore, I think it will be largely consumption-driven, partly supported by SME lending. And those two remain the key drivers. In fact, in our recent publication on thematic for next 5 years, also we kind of highlighting that there is room for more growth from these two particular segments.
All right. Hi, Vishal. Good to see you, Ben. But what's your approach, from the financial pack itself? Because that could be one way of playing it. But would you go for the NBFCs, private or public sector banks?
Yes. See, I guess, again, if you think from a growth rate point of view, NBFCs clearly, has been growing at a faster rate than banks even in past. I feel the environment is still supportive, easy liquidity, lower rates. They definitely.
Oh, I think we've just lost that line with Vishal. We'll try and reconnect with him in just a bit. Quick check on the market. By the way, the mid-cap market is really having a great Monday because the mid-cap index is outperforming the Nifty by a mile. And you have a very positive advance decline ratio as well on the NSE. Almost 3 stocks are advancing to just 1 declining stock. So it's looking good. Let's figure out what's moving then in the mid-cap market. We've discussed, of course, TBO Tech, but there are other names as well. One MobiKwik is on the move once again, 8.5% on the higher side. There's Acme Solar, there is GMDC, Prime Focus, where a bunch of very notable investors have checked in, including Mr. Ramesh Damani. That stock's locked up in 10% circuit. It hasn't moved, hasn't budged at all. So these are the key names on the upside for the time being. Let's just go back and check some of the stocks that were on the radar in terms of news as well. Vedanta is still stable. I mean, still down only 1.5 to 2%. And the real estate stocks, Suntech, where promoters have infused some money in the company, 500 crores, 3.5% up on Suntech. And Max Estates is also up and about.
Well, that's right. Let's focus on metals, though. And Morgan Stanley has come out with the note on steel. They've upgraded JSW Steel to overweight. The target price they've raised to around 1,300 rupees. They've also gone ahead and upgraded Tata Steel. The target price comes up for you on the screen, 200 rupees. And SAIL, the target price has been raised to around 150 rupees. 140 rupees, beg your pardon. They have an equal weight, though, on Jindal Steel. That target price they've raised, though, to around 1,150 rupees. Let's tell you the factors at play. They have turned constructive on steel spreads expansion. They're also expecting domestic steel prices to expand as the demand is likely to improve. They point out that China's anti-involution theme is also gaining traction. That is, they'll restrict production, restrict supply, which in turn will be good for pricing. And since China's the big king in terms of the capacity globally, well, if China does that, then that's good news for global prices as well. They say that the global macro factors are also turning favorable. And because of all these factors, they've gone ahead and raised the steel prices estimates by around 3% each for FY27 and FY28. So put all this together, Morgan Stanley has got constructive on steel companies. And last week itself, here at CNBC-TV18 had highlighted various factors at play, from anti-involution, from Fed rate cuts, the kind of measures taken by the domestic regulators here, or the central government as well, to protect domestic companies. And all these companies have done quite well. But I think Vishal Goel is back with us. Vishal, you were going to give us the preference, between NBFCs, private and public sector banks. Please go ahead, and good to have you on camera.
Yeah, sorry about that. I guess, I was saying that NBFCs have historically grown faster than banks because, they have smaller books and, again, focus more on consumption. Given the benign liquidity environment and funding environment, we feel that NBFCs would continue to grow faster at roughly 1.4x of banks. Banks also have corporate and agri books, which are not growing as fast as retail. And that's why I think NBFCs should be growing faster than the banks, even in the near term.
Okay, so NBFCs will grow faster than banks. Within NBFCs, Vishal, which segment are you more optimistic on? The ones that are more, say, gold loan focused, or is it going to be housing? Or consumer financing? We all remember what happened to Bajaj Finance, right? Just after the GST cuts were announced. So what type of NBFCs?
Yes, I think, housing will remain the largest, product along with business loans, which is SME and business loans. So those are the large two products. Actually, consumption lending in India is still very small. If you look at credit cards, it's only 1% of GDP. Even personal loan plus credit cards will be 8% of GDP. So I think there is more room for consumption credit to grow. We have seen some consolidation in this product in the last 18 months. Also, we've seen an NPL cycles in 23. And therefore, I think this segment can grow faster, especially given that the GST stimulus would be directed towards more on the consumption and basically should have some effect on that lending as well.
Okay. So that's on the NBFC side. For large banks, Vishal, what's the forecast as of now? Do you expect any of this? The fact that, The income tax cuts have also now, they're seeping through the system. This is the year that they're at play, and then the GST cuts. Large banks, how should one consider them, if at all?
See, I guess large private sector banks, they are still driven by consumption credit, and retail remains a large part of their balance sheet. So to that extent, they should be able to grow closer to 14, 15%. And that is like our range forecast for most of them. I think in terms of margins, we already know that this repo cut repricing would have some margin dilution in the near term. But beyond that, I think as we go closer to FY27, probably Q4, we'll start seeing NII growth also coming back for them. So I would say, we'll work with 14, 15% loan growth for this year, probably more NII growth next year as the margin stabilizes.
Vishal, even, I was shocked to hear it, but even the rate of growth in home loans as a segment, that has fallen very sharply, right? Single digits now. Sharp deceleration. So in terms of segments, where do you see the maximum delta if this is to pick up and go the other way?
See, I guess the maximum delta would still be driven by consumption, as I was saying. And within consumption, we have already seen, as I said, correction in the unsecured lending. That should start picking up. See, gold has had a very good run, right? Backed by the price, grown at almost 30% CAGR in the last 5 years. But that, I think, might still, continue to grow at faster than the credit, like maybe closer to 15%. I guess SME credit, business loans and SME credit, that book would also continue to grow faster than the overall book. So those 3, 4, I think I would say segments. See, auto, etc., would also see some pickup just because of the stimulus. But I think at the overall scheme of things, the size would be small.
So basically, a consumer and SME kind of loans, right? Those are the two areas.
Yes.
Right.
Yes.
That's exactly. We spoke with Sanjeev Bajaj last week, and those are the two segments he identified as well. And actually, other CEOs we've spoken to as well said, well, this is where the maximum sort of boost, etc., will show up. Just one more question, Vishal. Many banks and bankers we speak to say, well, the regulator is still very keen on doing more to reverse the sentiment and for lenders to be able to lend more in an easier way, etc. We've heard things like, a relook at risk weights on specific segments could be in the works. In terms of future steps from a regulatory standpoint, now rate cuts, is it one or done? Is it, are we going to see one more, etc.? We don't know. But is there other steps which could be meaningful? What could those be, Vishal?
I agree with you, Prashant. I think since March or April, I think regulatory situation is very different. I think from a tightening on all fronts in the last 2 years, we are seeing, relaxing and accommodative stance on not only on monetary and repo cuts, but also on some of the regulations for banks, whether it is ECL or provisioning or, like the risk weights on unsecured, LDR related, pressures, etc. So I guess there is at least a benign, environment from a regulatory point of view for growth to pick up. I guess now liquidity is already in abundant, right? So I think what regulator generally can do is relax more on LCR or, some like for the CRR cut also would be happening. So a lot has already happened in the near term. I guess if this does not pick up, then they could look to maybe, relax some more, internal regulatory, I would say, measures, which allows bank to lend more from the liquidity. But I guess I think the task at hand would be credit demand, right? Like how you get the demand to come back. One can be just simply lower rates. And the second could be, all this stimulus, which is already happening on the other side.
And both have happened, right? I mean, to some degree, at least in the near term. Vishal, just one last question from my side. When you speak with foreign investors that you advise on for stocks under your coverage, how is positioning in this space now relative to, and is that a factor at all, one way or the other? I remember a year and a half, 2 years, till 2 years back, I mean, the refrain seems to be, well, everybody likes the space, but everybody's already overweight. So then what's going to happen from here? But has that changed at all? Has enough time correction happened? What's the sense?
Yeah, I'll go back a little back in time. See, if you look at the positioning in the last 6-7 years, how it has evolved, it's basically it was hidden only defensive names, right? Some quality private sector names. No exposure to SOEs, no exposure to the smaller or no struggling private sector banks. From there, it basically became almost everything you own in the sector. That basically happened maybe a couple of, till maybe last 18 months. And in the last 12, 18 months, what we are seeing is again some shedding, I would say, or reduction in the low quality names. Or low quality in the sense like the names which are not performing as much. So within private sector also. And so overall, I would say from I like there is difficult to put a number whether how much overweight was there, but from high overweight it could have been a low overweight, or the weight definitely has reduced. That's the sense I think we get when we speak to them.
All right, Vishal, the last 3 or 4 years, if I were to pick up one set of finances actually that have re-rated, could be the power financiers. They have really moved up. Do you think there is still value out there? And also, if you could comment on gold finances, because, this is an ancillary way of playing the theme. If you're bullish on power, maybe if you want to play it via the financing theme, then some of these power finances have done well. And we saw what, a couple of those gold finances, the numbers that they have delivered, and those stocks have, seen a big spurt up. So do you think there's more potential?
Yeah, I guess, Nigel, gold is, the price has helped. Plus, like if you see the gold AUM CAGR is 30% in the last 5 years. So it's phenomenal. Like it is kind of the best in the overall financial services in terms of growth. Can it continue further? I mean, lot will also still depend on, whether the gold price, remains here or there is a sharp correction from here. We don't cover the names in particular, but I think we are expecting around 15% growth from this segment, given that the base is already very high. There's nothing, wrong in the business as of now, but generally, I think we think from a very high base, we should see a 15% kind of CAGR over that. I think on your question on power finance, yes, I guess we are positive on that segment. I think in particularly because the valuations are reasonable and ROE etc. are decent. I think in terms of growth, while there are a lot of discussion about growth picking up, I guess the struggle for these financials has been the loan growth numbers, right? And the low teens or close to teens kind of growth numbers is what right now expected. If that surprised positively, I think there would be a good re-rating potential in some of these names.
All right, Vishal, we'll leave it there. Thank you very much for joining us. It's a good conversation and good insights from you as always. Thank you for joining us here on CNBC-TV18. 80 points on the Nifty is what you have, so 24,824. We've been highlighting all the names which are higher. I just want to look at the other side as well. By the way, it's one way. So advanced decline, 2,000 up and about 700 lower. So almost 3:1 in terms of advances to decline ratio. Amber is down 2%. It's, I think, it's basically from the highs. It's come off quite sharply. And I'll tell you, from on Friday, it closed at about 7,800 bucks, basically, was the close. It rose to about 7,850, and now stocks at about 7,600. So it's actually dropped quite sharply from the opening gap up that we saw on that one. That is Amber. Lots of other stuff also moving, but I mean, the weight of volume, etc., is largely on what is going up, not what is going down. Vinay Rajani is with us, a senior technical and derivative analyst at HDFC Securities. Vinay, good to have you with us here. Good morning. How would you trade the market? What would you do on the Nifty indices? And then, of course, your stocks.
Yeah, good morning and thanks for having the show. So 450-point rise from the lower level, 24,400 is a very strong base. From that, we saw a bounce back and gradually Nifty is getting strength. Now it is above 5, 10, 20, and in fact today it has surpassed the 50 days EMA. So gradually markets are getting strength. Overall, if I were to talk about the 24,400 to 25,000 is a broader range for the market. And for as far as Nifty is concerned, yes, above 25,000 we will get a confirmation of a bullish breakout. By that time it will be too late for stock, because if I were to see the broader markets, it is getting stronger day by day. Started with the auto sector, followed by auto ancillary, then FMCG, then metal stocks. Some of the hotel stocks performed very well and they have been doing well And now I can see some railway stocks building strength on the charts. So gradually, many stocks have started performing. Momentum is started building up in many of the stocks. So broader market is performing well. If stock pickers in the mid cap and broader market segment wait for the breakout of 25,000, it will be late also, because no doubt about 25,000, there is a breakout in the Nifty, but broader markets are throwing a lot of opportunities for the traders to trade in. So I would suggest that one should remain with a positive bias. One can trade in the market, and stocks and sectors which are performing well, we can trade, and there are a lot of opportunities are there. So 25,000 above which we can get a fully bullish breakout setup in the Nifty. Bank Nifty level is 54,500, above which we will get a breakout. But I think one can look at the stocks which are giving a lot of opportunities on the to generate the alpha in the short term. So yes, there are stocks which looks very strong to me. One of the sector and segment which is fresh breakout on the chart is the railway space. So RVNL looking good around 334. Stop loss can be kept at 325. On the upside, I'm expecting a target of 350 in next 3-4 session. The second pick I would take from the outperformer sector, which is auto, and that is commercial vehicle segment, Ashok Leyland. So Ashok Leyland around 135, 136, one can go long. 132 should be the stop loss, and on the upside I'm expecting a target of 140 to 141. So overall this space is likely to do well, and stock specific there are many opportunities which can be traded with the appropriate stop losses.
Okay. All right. Thank you very much for that. We'll keep those levels in mind as well for the index. Need to take a quick break. Come back on the other side. We'll have Manisha Gupta joining in with a roundup of all the commodity market action and a couple of the key stocks which are hitting the headlines this Monday morning. Welcome back. So the equity market is having a fine Monday morning. No problems there. Let's figure out what's happening in commodities. Manisha is joining in. Manisha, what's the latest?
Well, it's a kind of a morning where you have everything trading on a higher side. So you have gold near all-time highs, silver at 14-year highs, crude oil prices taking higher, coffee, rubber, everything is firm. But I want to focus on the global food prices. And there's an FAO report which has come out with the global food price index for the month of August. The prices here are at a 2-year highs. So when you look at a month-on-month jump, it's not so much. But on the yearly basis, we are up by 7% as compared to August in 2024. So strong commodity prices is what we are working with in here as well. So the prices are highest since Feb 2023. And the major of gains really seem to be coming in case of sugar and edible oils. This is where the inflation really seems to be catching up in the international markets there. I'll start with vegetable oils because here you have the highest inflation, 1.4%. The vegetable oil index is trading at the highest in 3 years as well. Now, there is gain in case of palm and sunflower oil prices, and that is because of the biodiesel mandate that Indonesia really seems to be putting with. It started with B30 and B40 and is talking about B50 as well in sense of blending in the next year. That is where sun and palm get their support from. It also has to do with the maize prices, which also are trading on a higher side because of the US feed and ethanol demand. So everything which seems to be getting divided in sense of food, feed and fuel is trading on the higher side right now. And then it also has to be with the meat price index, where you have seen 0.5% of gain, trading at a record highs in the global markets there as well. Sugar prices gained up too after 5 months of constant declines because of higher production expectations in Brazil and India. You have seen sugar gain up on the index as well. What has seen a decline, though, within the food price index has been one, cereals. This is down for a fifth month and down nearly 0.8% on a month-on-month basis. The other is wheat, a big decliner really, because we're looking at a very big harvest in European Union, in Russia. Indian wheat crop also expected to be strong. And then it is about rice, where India is the largest producer exporter as well. And with Indian prices of rice trading at a 3-year lows, that is impacting the international food price index also. Another thing that what the FAO has done is it has come out with the global cereal production as well. They're looking at 2025 gaining by 3.5%. And now this is a new record highs that we're looking at. Maize has surged up by nearly 6%. Not so much in case of wheat, but you have seen rice, which also is looking at higher production. So when you look at wheat, cereal, maize, rice, higher production numbers in the global markets are keeping these prices under check.
All right, Manisha, thank you very much for that. That's commodities with food grain, cereals, etc. under the microscope there. Manisha, thank you for that. Well, let's talk about real estate. Suntec is in focus and Max is the other one which is in focus as well. Ria is going to put the spotlight on these two names once again. Ria, over to you.
Well, yes, both of these stocks are in focus today. First up, looking at Suntec Realty, they have issued 1.17 crore warrants convertible into equity shares, aggregating to about rupees 500 crores. The issue price for this is rupees 425 per share, and this will be allotted to the promoter and the promoter group, who are going to subscribe around 66.5% of the total issue. Other investors for this include NT Asian Fund, Utpal Seth, as well as Mukul Agarwal. The next one is Max Estates. They have secured the development rights on a 7.25-acre land parcel. The group housing development potential for this is 1.3 million square feet with a GDV potential of over rupees 3,000 crores. The in today's session trading higher by around 3 to 3.5%.
All right, Ria, thank you very much for that. So those are real estate companies in focus. We're going to take a quick commercial break here. We're going to come back with a very special conversation. My colleague Lata will be speaking with KVS Manian, the Federal Bank CEO, on the outlook for the bank. That's coming up in just a quick bit.
Welcome back. Post the GST cuts, we saw NBFC stocks like Bajaj Finance run up on hopes there will be more consumption and more consumption loans. Logically, banks should also benefit from such a consumption growth, but banking stocks did not react immediately after the news. To assess the outlook after the bunch of government steps to spur consumption, I have with me an ace banker, Managing Director and CEO of Federal Bank, Mr. KVS Manian. Good morning, Mr. Manian, and thank you very much for coming to our studio. It's still only 2 days after Onam, so happy Onam to you as well.
Thank you, same to you.
Well, let's start with this GST rate cuts. Do you see consumption getting a boost?
So I do hope that the consumption gets a boost, though of course there will be some hold on to the demand for this month, I guess, most part of this month. But hopefully from the next quarter, we'll see some impact in demand. The way I look at it is this is good from demand perspective. Interest rate perspective, I am not yet sure where it goes.
Yeah, I'll come to that, cost of deposits and interest rate cuts. But just to finish the growth argument, you know, your best performing sectors were commercial banking and CVs. Those were the two pillars in the just ended quarter.
Right.
Would you expect that CVs will do well simply because the cuts have come?
Yeah, so CVs, it's good for CVs, that is one. But Lata, the way I look at it is we are still a small player in CVs, so we should do well irrespective.
Okay. Oh, irrespective.
Yes.
And what about commercial banking? Do you think that the consumption can spur more? From commercial banking are still large SMEs.
Yes.
Or MSMEs.
Yes. So, I am more, if you see our last quarter also, we have put more emphasis on the commercial banking, and the small business have still grown slightly lesser than that. Because we are feeling more confident about the large SMEs. Okay. The tariff impact on small SMEs, we are kind of wanting to assess that, what the implications of those will be. And as you know, many people in the industry have called out, though our book is not showing any signs of stress. Many people have called out stress in the
Finance Minister has promised
SME.
a package.
Yes. So
she spoke to our channel.
Yes. So I am hoping that that part also picks up. But commercial side, the larger SMEs, I think we are very confident. Our book is very good, and we want to continue to grow that book.
Okay, so let's come to a number. How do you expect credit growth for the full year, for this quarter, for next quarter? Any numbers you can give us?
So, Lata, we've been guiding that we will grow at 1.2 to 1.4 times the nominal GDP growth. Of course, nominal GDP has taken a hit just now, but I'm assuming that through the next 2 quarters, it will normalize a bit. So, we continue to keep that guidance as
1.1 to 1.2.
1.2 to 1.4. If the credit growth is muted, we'll probably operate at the lower end of this. Otherwise, we'll operate at the higher end.
Okay, now let me come to the cost of funds. Have you all seen a fall?
Yes, of course. Of course, we have seen a fall. As you know, we dropped our savings rate also and term deposit rates as well. And we have continued to grow our deposits in spite of that. So we have seen a drop in funds, cost of funds. Last quarter, if you looked at our numbers, our cost of funds dropped by more than 18 bips.
So did the NIMs.
So did the NIMs. Of course, NIMs, as you know, are dependent on, nowadays, most banks have 40 to 50% of their book in the repo linked assets, and it's a natural drop.
Loan.
So we are hoping that the fall in cost of funds continues because the deposits will continue to reprice till May. Okay. So we think it'll...
another just near-term number. If there is no rate cut, what are your NIMs likely to be now and by the end of the year? If there is another cut, which can happen because of the CPI fall, then what are your impact on the NIMs now and end of the year?
Right. Again, Lata, we have guided that up. Post our last quarter, we said that we are close to the bottom of our NIM and ROA trajectory. Because if you know, we reprice T+1 basis. The day repo drops, we reprice it on the same day. There are banks that go up to 90 days on that. So we've taken large part of the fall already. And therefore, we think we are close to the bottom. We had guided that not less than 5 to 10 basis on the NIM side.
So 2.94 can become 2.85, not lower than that.
Yeah, not more than that. I mean, hopefully
but
better.
When does the U come?
So I think we should see uptick from here on.
Second quarter itself?
Second quarter, like I said, there may be small impact, but after that, the next 2 quarters of the year, we should see an uptick.
Okay.
On both ROA and...
So your year-end NIM could be over 3?
Yes, of course. Yes.
Okay.
Surely.
Okay. So now let me come to the MFI issue, which obviously showed up in higher slippages for you, higher credit cost.
Yes.
What's the sense?
So, as you know, if you saw our last quarter, there are 2 things I want to talk about. One is the increased credit cost we took was primarily because of MFI. If you looked at the slippages of all the other non-MFI assets, they were exactly where they were 1 year back. Our slippage was 0.77% sans the MFI thing. It remained exactly the same 1 year later, 0.77 to the second decimal. Okay. So the primary increase in credit cost came out of the MFI business, where we feel the peak has already happened. May was our peak month. We have seen drop in slippages since May, June, July both. August we have not gone public with the data, but June, July we have seen a drop, and we think we are past the peak on that.
Okay.
And we've also guided that in spite of the fact that we took a 65 basis credit cost in the first quarter, our annual guidance on credit cost remains 55 bips. Okay. So we have not changed our guidance.
You expect the provisioning to come down?
Yes.
I mean, loan loss provisions to come down.
Yes.
What about MFI? I mean, we just had a note from CRIF. They were a little, MFI, MSME and SME.
Right.
They were a little worried. They are seeing trouble. So do you think MFI goes down, but business banking, for instance, can show more...
So like I briefly mentioned earlier, we aren't seeing any stress in our SME portfolio, business banking portfolio. Okay. But having said that, it is an area that I want to tread cautiously for sure, because like I said, people have called out stress, and there are small SMEs which can have impact due to tariffs, and hopefully the package that the government is talking about happens, then it will give us comfort. But just now I remain cautious, but I'm still optimistic. It's not that we don't want to grow that book. We want to grow that book, but we will be relatively more cautious at the lower end of SMEs than at the upper end of the SMEs.
Okay. So overall, what is the ROE guidance now? Now, after the new developments in tax cuts, new developments in tariffs, what is the ROA guidance?
So, like I said, we have probably seen the bottom of our ROA journey just now in this rate cycle. Of course, subject to no more new rate cuts. I think we should see an uptick from here.
Okay. No, I'll tell you why. Because this quarter, you all are not going to get other income. Your last quarter for all the banks, although net interest income fell, this other income component, because of the rise in bonds, helped.
Yes.
But this time there will be bond book losses.
Yeah. So, Lata, if you looked at our last quarter, our pure fee-based income also grew by more than 20%, 21% actually.
Yeah.
So we are also growing our fee income strongly. So yes, you are right that on the prop side, there may be some impact of the higher interest rates. But, you know, these higher interest rates, as you know, this has been range bound, right? 20 bips here, there, and you don't know when it retraces back, the interest rates retrace back. If the next CPI call is lower, you never know the interest rates.
The CPI call is going to be lower. So I think bankers have to be prepared for a larger possibility of another cut. I mean, we can't read the RBI.
Right.
But if most economists are pricing in a cut, therefore, what is the ROA trajectory?
So the further cut will impact ROAs. There is no question about that. Again, we should be clear that will be the case. Having said that, you know, there are 2-3 things we are doing. One is, if you see our dependence on floating rate assets is going down. 1 year back, 53% of our assets used to be floating rate. Today, they are 48%. Okay. So we are also, reducing that. Okay. So these should help us, mitigate the impact of falling interest rates. Of course, we are also trying to change the mix of our liability side into more CASA, which also you have seen last quarter, the results have been good on that.
Oh, yes.
So I would say mix of things. There will be things we will do to defend the drop, but there will be some impact, of course. And if you noticed our last quarter results again, the drop in NIM that we reported was significantly lower than most analysts expected, right? Because of all these cost of fund drop and the mix change on the asset side, all of that is also playing out. Okay. So we'll continue to do our best on all of that.
Okay. Anything we should know about your subsidiaries, the NBFC or the insurance, any other activities that you are planning?
On the insurance side, as you know, we have an approval to take our stake from 26 to 30%. We are in the process. Yeah. So we have both the approvals in place now. RBI as well as IRD approval is in place. So we are in the process of executing that transaction. So we'll take our stake to 30%.
And on FedBank Financial Services?
On FedBank Financial Services, it is status quo. Nothing, no plans.
And no capital raising either?
No capital raise either.
Okay. No, I mean, even for federal?
Even for federal, not just now.
Not just now, as in how long will your capital last?
No, so I think we are at 16% capital adequacy just now. So I think we are okay. Something like a year we can do without capital raise.
With this kind of growth, yes. Okay, and finally, you gave us a 2028 ROA goal.
Right.
You want to refresh it?
Yeah, no, so...
that was the 2% goal.
It is not exactly 2, but ROA 2 is a bit high. But I would say 1.5 kind of an ROA is what we want to aim for in the next 2 to 3 years. And that's what we said in our February analyst presentation. And that's the direction we are moving in. Of course, the number is important. But, it depends on the macro, what the overall industry ROAs look like and all that. But, yeah, we are directionally headed towards the 1.5 and 14-15% ROE, 1.4, 1.5.
We do hope by 28, a lot of the tariff uncertainties at least will settle down.
Yes.
And our growth path will be far more clearer.
Yes.
Thank you very much.
Thank you,
Manian,
Radha.
for
Pleasure
dropping
being
into
here.
the studio and for chatting with us.
Thank you so much. Pleasure being here. Thank you for having me.
Well, we have to wrap up on Bazaar on that note. Chartbusters coming up after the break.